So
Thank you.
take it away.
Yeah, thanks, Taylor. Let's see, got my audio. Let me uh, share my screen. Excited to be able to talk to everybody at CMO Zen. So CMO Zen is a boutique fractional CMO firm. We do fractional CMO work, usually for companies that are kind of pre-Series B. We also don't do a lot of work with e-commerce or direct-to-consumer companies, but we do some B2C, usually service-based businesses, and then we do a lot of B2B SaaS and technology companies. Yeah, it's been my pleasure to know Taylor now for all of these years, however many that actually is. Uh, and It's been great to see what he and Spencer have been doing with Summit Venture Studios, and the Midday Connect has been a great opportunity for me to meet you guys, and looking forward to meeting more of you as the audience grows. So today, what I was going to talk about is marketing in the sense of what is it like? What's the marketing aspects of raising money? And I have not raised the most money, right? Like over the course of my career, I've raised probably $30 million, meaning that I was involved in pitching investors for about $30 million. So not a ton. There's people in here who both invested more and probably raised more than I have. Along the way, I also started teaching courses in venture capital at the University of Utah, which kind of motivated me to keep my finger on the pulse of that community. And so I'm going to share with you some things that I share with my students. One of the biggest sort of marketing angle about raising money, in my mind, is the first question you're asking yourself in marketing is about the audience. Who's the customer? Who is it that you're talking to? And who's it that you're trying to persuade? And so what I'm going to share is some things that I've come across about how to understand investors. And I'll start with, let's see here. Start with a little comic. So this is a common, this is a riff off of a common saying in startup land. So what are those down there? Those are startups. They jumped off the cliff and tried to build the plane on the way down. And thank you to Midjourney for being my comic book artist on this one. So here's the first point that I want to make. It's really common to hear people say, "Oh, you can only raise money if you do this," or "Only these companies are raising money today," or "You'll never be able to raise money if you do this," or "Investors only care about this." And so the first thing I'm going to share with you is that I think that hard and fast rules are generally BS. It may be possible right now if somebody's saying, "Look, AI companies are raising all the money." That's mostly true. But there are still things that happen on the fringes, and investors are individual people. They don't all care about the same thing. They all play in different areas, and so the first thing I'm going to say is that I think hard and fast rules are BS, and now I'm going to give you some of the hard and fast rules that I go by. So just take this with a pinch of salt. The first thing is that founders think that money is scarce, and investors think that good deals are scarce. And I personally believe that both of these things are not true. But this motivates a lot of the mindset of investors. So if you're out raising money for your company, know that there's a power dynamic that's kind of weird because the investor has the money and you're coming asking for the money. But investors also think that great deals are scarce. And so if you look like a great deal, the power dynamic shifts. And so that's just something to be aware of. I call this the paradox of pattern matching, which is pattern matching is a really popular phrase among investors right now. But it's and it makes sense, right? Like if you look at how we make decisions, pattern matching is kind of a way of saying I trust my gut, or I've seen what this looks like before, and I'm looking to see it again. And what that means is that I'm also tapping into all of the power of my unconscious mind to help inform me about making decisions. And so pattern matching, I think, has been effective for investors for a long time. And it's also delivered us a lot of sexist and racist investing because your gut doesn't care about what's politically correct. And so I think that both checks on pattern matching are important, and also because investors say no way more than they say yes. So it's automatically a process of discrimination. And so in our current climate, I think this is one of the challenges, is the paradox of pattern matching. If you're raising money, you got to kiss a lot of frogs. So prepare for 100 pitches. And what you need is both conviction and humility. So if you make a dozen pitches and nobody likes what you're selling, you haven't made enough pitches to really know what the market thinks. If you made 100 and nobody likes what you're selling, then probably it's time to think about a pivot. You might want to take a closer look at what, like, always take feedback, but you also need enough conviction that you can do 20 pitches, people tell you that they hate you, and you keep going. So think about that. And then I'm going through these kind of quick because I'm kind of erring on the side of information density for this presentation. I want you to make sure that there's takeaways. And so the next thing I'm going to share with you is 12 reasons that VCs say no when you're raising money, and that these are things that they will almost never tell you. So I think that's valuable. And as you're trying to put yourself in their shoes, a lot of it goes back to that investors think that great deals are scarce. And being an investor is hard, especially like in traditional venture. It is not easy to say, like, let's say that you're a big firm, right? You're in Andreessen Horowitz and you just raised like $1.5 billion. And the only way that you can make money with that is to invest it in the riskiest investments in the world. And you have to do it well enough that you generate returns better than the market, because otherwise you should just put your money in the market. So you got to be generating, like, across your fund, right, an average of north of 20% returns. And you have $1 billion to put in startups at $5 and $10 million at a time. Like that is a really difficult thing. That informs some of these. So, okay, the first thing is that you're not swinging for the fences. So this is the power law of investing. Usually there will be one deal in a fund that returns more than the rest of the fund combined. If you don't look like you could at least have a chance at being that deal, then the investor really can't take the risk on you. They just can't afford to do it. Another thing is that investing is hard. So I like to say that all companies at the startup phase include flaws that could metastasize and kill the company, all of them. Because if they had no risk, if the risk is already beaten out of the deal, they'd be mature companies, because that's part of how you get rid of risk. So all of these companies could fail, and that means it's a hard place to make money, and that means that investors have to be picky. So let's say that here's another thing: is investors don't make as many investments as oftentimes you think. So if you were to look at especially like in our local ecosystem in Utah, where the sort of seed and Series A VCs they're relatively small, their fund sizes are relatively small, and so usually they're making sometimes single-digit numbers of investments per year, sometimes low double digits. And so if you think about, let's say that you're running maybe a $30 million fund, right? Those are really small. And you're going to invest in half a dozen companies this year. You could be, the seventh best company and not get investment, because they really are. They can only afford to look at the top. Another thing is just the relationship, the momentum in the relationship. I mean, I've seen this a bunch of times where an investor comes back to you and says, "Okay, I would like to see your financials," and you're not ready. You're not prepared. And so it takes you 3 weeks to get back to them with financials. And by that time they've moved on. And it could, that example could be played out over it doesn't have to be financials. It could be any number of things where you're not really prepared and you're not managing the relationship by being on top of things. And the momentum, it's an emotional thing. And so in the time that you're waiting to get back to an investor, they're seeing 10 more deals. And so you just have to keep the momentum going. Another one is no dry powder. Investors don't tell you when they don't have dry powder. So dry powder it means they have money to invest. But investors, they're raising funds, right? So let's say I raise the fund every 24 months. Well, the dynamics of where I am in that fund make a difference about where I'm going to invest. Maybe I only have enough money left in my fund to do one investment. This is the last investment. And maybe I don't feel that confident about how the first investments are going. So my standard for what I'm going to invest in is going to crank up. Or it may be that I don't have enough money to really invest at the check size that's needed for this investment. Or it may be that I raised money in 2022, like this will hit home for some people. I raised money in 2022 when the getting was good and money was easy to come by. I survived on that money through 2023, and now I'm in 2024 going out to raise money and finding it more difficult than I did in 2022. And so I don't have money to invest. But also I think deals are scarce. So am I going to tell you no if you come by and want a meeting? No, I'm going to still take the meeting. I'm going to still take your time, and I'm going to still listen to you. And I might even like your deal because I don't want to limit my options, but I have no capacity to invest. And I'm not going to tell you about it. The other thing is the Goldilocks principle, right? Sometimes as trends and rumors affect investing, right? You've heard this saying that buy on rumor, sell on news. The winds of change that move through the information that's moving through the investment community impacts how people invest. And so oftentimes people are looking for this. The Goldilocks principle applies to check size. It applies to industry, right? They're looking for something that's not too hot, not too cold, but just right. Sometimes you won't know this, but an investor will have like their partnership agreement with their LPs or their investment thesis will focus on a certain industry. They may only invest in tech companies. They may right now only invest in AI companies. And they don't have freedom to change that. If I'm talking to an angel investor, they can invest they're investing their own money, they can do whatever they want. But if I'm talking to a venture investor, they're bound to make investments according to a certain thesis. And so that thesis may not include your medical device company or your, whatever new construction product. And you can kind of parse this out by looking at what they've invested in before, right? Because all those companies will match their investment thesis. But if you're out of alignment, you could go to an investor that they love you, they love the potential of your company, but they can't invest because you're not in the right industry. Similar to that, you could be in the wrong place. So the hottest investment community in terms of the most dollars invested in startups and venture capital is the Bay Area, right? San Francisco is the hottest. Then you've got Boston and New York are second and third. Every place else is way, way, way down the list. Like Salt Lake, way, way down the list, right? We're like, even like Austin, way down the list, but still beating out Salt Lake. And so as a result of this, sometimes investors are thinking about things that's like, well, okay, if I invest in this company, am I gonna have to travel to board meetings? Like there's plenty of companies here in the Bay Area. Why should I invest in a company in Salt Lake? Am I going to have to, maybe my investment thesis limits me. Likewise, there are some investors who are like, hey, we think that the flyover country in the middle of the US is being overlooked by all the investors on the coasts, and we're going to try to create a competitive advantage in the middle. But geography sometimes matters. And that's something you're going to have to look up. It's unlikely that they're going to tell you, oh, hey, I love your company, but I don't do investments in Arkansas, for example. Another one, this is another thing that you can try to figure out, but it's difficult and investors won't usually tell you, but their portfolio mix will color their decisions. So let's say that they've already made an investment to a company. And when an investor makes an investment, it's like they switch sides. From being adversarial, they're like on your team now, or they're on the team of your success. They want your company to win because if you win, they win. So let's say they've already made an investment in an inferior competitor to you. They're still not going to invest in you because they're already invested in the competitor. That's their portfolio already contains something that's like that. Or maybe that they have companies in their portfolio where they're looking not for anti-competitive things, they're looking for complementary things. And you're not complementary to what's in the rest of their portfolio. And that could be all kinds of reasons, right? It may be some of those things like location or industry, or it may be that, hey, our dry powder is shrinking and we need this sort of kind of deal in our fund. It may be diversity and inclusion things. Like we need a female-led company or a person of color-led company. And if that's not you, they won't tell you, but it will be portfolio mix will keep you from getting investment. This is one that you can actually do something about, but they may not tell you that this is why they won't invest. There are lots of ways to clean up weird things in your cap table. And companies get started weird, right? Like oftentimes we take money from wherever we can get it, And sometimes that money is regrettable, and so we get down the line and we have weird kinds of investors or weird kinds of weird series of capital, and all that has to kind of get cleaned up in order for us to hit the model of an institutional investor. So if our capital stack is ugly and somebody that's right next to us that looks roughly equivalent to the investor, their capital stack is clean, why would they go to the headache and expense of investing in a company with an ugly cap stack? This is also bigger. Investors may not tell you this because they may not even be aware of it, but it turns out that investors are human beings. They're influenced by things that influence human beings. And one of those things is social proof. If you're raising money, the most difficult investor to land is the first. Like nobody wants to be the first kid in the pool. And so in this case, if you have that first investor, the social proof will help you get others. And part of this too is because, especially like if you look at our community of investors in Utah, where there's a lot of seed and A investors, so the early stage, smaller check sizes. If you look at them, those organizations, the companies themselves, those VCs are actually startups themselves. They don't have big teams. They can't afford to do extensive due diligence on all of the deals. So what they do is they syndicate in order to draft on the due diligence of others. And so that social proof is an important signal to them about the value of an investment. And that way they can borrow on the due diligence expense from other investors in their syndicate. So lack of social proof is a really big thing. If nobody else is interested in your deal, this is also, and investors talk. So if you go in and you're like a jerk to one investor and think that nobody else is going to hear about that, that's probably not true, right? And the kind of reputation of you and your deal will get around. And so social proof is important. This is my last on my list of 12, is if you need a champion inside the VC firm. So you need somebody who's willing to put different firms have different ways that they structure this, but it's common that somebody will have the flexibility to greenlight a deal if they really believe in it. If nobody really believes in the deal and nobody's saying, hey, I think this is going to be great, then oftentimes they'll pass just because, well, we'll wait until we have a higher level of conviction and belief about a deal before we'll make the investment. So as you're building the relationships early on in the fundraising process, those relationships really matter. You need somebody who will go to bat for you when you're not there, and who believes in you and in your deal in a way that they will represent that to the rest of the fund. And I'll give, this is a bonus, right? Not all money is good money. This can be really hard when you are desperate for money. But figure out what is a bad deal. Figure out what terms are deal breakers for you, and know when to say no to money. By bad money, it sounds like there's bad actors. It's probably not that. It's just that everybody's out for themselves. That saying, nobody's really out to get you. They're just out for themselves. And in this case, that might mean that an investor offers you terms that are what they're willing to accept. It's good for them, but it might be bad for you. And so the better you understand that, the more that you know when a term sheet comes across your desk and you're like, I can't take that because I already know these terms work for me and those don't. Okay, that's pretty rapid fire. I hope that's been okay.
Chad, that was awesome. Thank you. I mean, everybody does a top 10 list, but going the extra mile and giving us a full dozen.
That's right.
And then giving us a baker's dozen with a bonus. Like, can't match that. So thank you.
Just trying to, force feed. It's like gavage of information, right?
I love it. I think we're at a group size where it might make sense to put your questions in the chat, or you can also just come off mute and pummel Chad with some questions. So feel free to do both. Now.
Hey, okay, I'll go first then. And Chad, man, that was an awesome presentation. All the pictures were just like, I'm a visual guy, even though I am in sound. Paradox. I I'm in Dallas, Texas, and everybody says, "Oh, well, that's where one of the biggest sharks in the world is, Mark Cuban." Well, I get to see Mark in places around town whenever I am out and about and doing things. And the last time I saw him, he did describe about his time on Shark Tank. He said, if I invest in you, I own you. You will send me a report every single day about every single nickel that you spend. It will go to my team. They will evaluate it. And then if you do not return on the ROI exactly to the term sheet, I will take your company, invest 10% more into it, and I will sell it for a 200% profit because my name is a brand. Now, those are the kind of people that I run from, okay? Without even pitching what I'm doing. Because, you've really got to work with everybody. It is a startup, and you see that. And that comment that you made about having somebody go to bat for you and have your back and pitch for you, man, that just means all the difference of the world to be able to move forward. So, man, it just makes what you just said very valuable to me. So thank you again.
Yeah,
Maybe
thanks.
question there,
Thanks.
Chad. How do you find that champion internally?
Yeah.
Well, part of the premise of my presentation is that these are things that sometimes you don't know, because the VCs don't usually share this with you, but these are operating in the background. So really what I would say is that it's about the relationship that you have with the people that you meet along the way. That's where you get the window into what people are thinking. And so you need a champion, but you may not know 100%. Like, not everybody wears all their thoughts on their shirt sleeves. But you should be trying to develop that. It should be an intentional goal to be developing a relationship with somebody who's gonna, like, they just think that what you're doing is the greatest thing ever. And I think I'll share something too, just responding to Alan's comment. I think if you watch this over a period of a few years, not just a slice in time, you start to see, like, there's ebbs and flows as the economy changes, as the market changes. Things, conditions sometimes are better for founders, sometimes they're better for investors, and so you kind of have to watch for that. But one of the traits is, if you watch for upside maximization versus downside protection in terms, that usually follows whether it's a buyer's or seller's market, and that is one way. Like what you're saying, Alan, about Mark Cuban, it's like, that's great, Mark, but if I have the deal that you really want in, now who's in the driver's seat? That's great if he's in the driver's seat. He's a shark, right? In Shark Tank, the sharks are always in the driver's seat. But a great deal comes in, investors believe that great deals are scarce. And so as a founder, you need to know when your deal is like that, because it's like, well, okay, great, Mark, but you don't get to play here, not under those terms. And that can be a hard thing for a founder to say, to look, essentially money in the face that is the potential for them growing their company or not, and saying, it's like, no, this is where I need to be firm about these terms. I think that Brad Feld in Venture Deals does a great job of kind of narrowing the terms that should be deal breakers down to those that impact economics and control. I think that's a good kind of rule of thumb. So there are a lot of terms that don't really matter that much. But if you look at control, and the economics means who gets what, right? There's a saying that, when it's time to divide up the pie, a lot of people show up with knives and forks. And so you spell these things out up front as a way to kind of to protect yourself, and make sure that you're okay with the outcomes, right? Good, bad, or in the middle. Anyway, that's just my response. Thanks for your comments there, Alan.
Hey, I've got a question for you, Chad. That was great. Like that was a great deck you ran through. Thank you. My experience in liquidity events revolves around helping owners do majority sales. So I'm on the other side of the spectrum that we talked about here. What I'm curious about, and this is my question, is then we worked with a broker, right, to help sell and connect us with people that wanted to buy the business, that'd be applicable. When you're on the fundraising side, earlier in your company evolution, are there types of contacts at these firms or investment firms that you should work on connecting with in order to further that relationship, get that meeting?
That's a great question. I guess what I would say is part of it is that there are some things that are kind of cookie cutter and some things that are really customized, right? The size of firm changes, right? Who does most of the screening? Like you may start your relationship with somebody who's kind of junior, and you want to try kind of trade. They can't greenlight your deal, so you want to try to trade that relationship into one with somebody who can actually act as a champion. And then there are some people give associates a lot of heft, but in general, you want to try and build a relationship with somebody who actually has. It's kind of like in a sales process, right, Danny? Like we're still looking for BANT criteria. Who has budget? That's dry powder. Who has the authority to do it? That's somebody who has a title or authority in the firm enough to greenlight the deal, and need and timing. So it's the same thing that we would look at in a sales process. How do we get it? I mean, fundraising really is a sales process. And so you're just looking at what do I need to close the deal, and I think I would use that lens, depending on what who you're talking to, who you're able to get an audience with. I'd use that lens.
Chad, you've seen a lot of pitches. What are the top 2 or 3 mistakes you've seen people do when either getting their pitch out the door, sending it to people, and or what they put in a pitch?
Well, good question. I think so. This is another one of those hard and fast rules that you should always think are BS, but here's one of mine. And that is that ultimately, like, there's lots of types of pitch decks, lots of types, should you include this slide, should you not include this slide? I think that every pitch wins if it has 2 things. It needs to be a compelling opportunity where somebody's going to feel FOMO if they don't invest. And then most of your pitch is about reason to believe. So opportunity and reason to believe are the keys to winning at a pitch. And your reason to believe includes all these things, like your track record. Well, maybe I'm a first-time founder, I don't have a track record. Well, what are you going to bring to compensate for that? So I think those are big things. Making sure if you miss those, I think it's really hard to get a deal done. I think another one is your vision big enough and bold enough? And also, how convicted are you? Like ultimately, right, the earlier you go in a company, the more that the investment is really just about the founder. And that makes sense, right? At first it seems, well, that seems unfair. But the reason for that is that a great product cannot overcome a bad founder, but a great founder can turn around a bad product. And so that's why there's so much emphasis on the founder. And then, right, your conviction and belief in the deal. Like what you want is an investor to walk away from this and you're like, look, my deal is inevitable. The success of this deal is inevitable. We are going to win A, B, C, and D. The only question is if you want to be on board. You want to be in a place where you can actually legitimately feel that strong about your deal. And that's, I mean, this is a little bit hyperbole, but it's catnip for investors. Because if you're wishy-washy about your deal, they're like, well, how am I can't jump into a deal and be the guy who believes in it the most. So those would probably be my top 3.
Awesome. I was just taking notes over here. That's awesome. The opportunity and reason to believe. I won't capitalize on questions if others have them, so you can unmute yourself or jump into the chat.
I was hoping to build on the founder question, so thank you for teeing that up. Hi, I'm Joanna Jacobs. When you say that it's always about the founder, is it about the founder's vision for the company? Is it about how easy they are to work with? Is it about how much the financials have sort of been thoroughly thought through? Is it about the competitive landscape and the founder's understanding of the environment? Like what, or is it all the above that you need to really champion for the founder?
Yeah, great question. So probably all of the above is the right and safe answer. but when you look at there's logic behind patterns. So there's a reason why investors like repeat entrepreneurs, serial entrepreneurs, and that's because the recent past is the best predictor of the future. It's not a certain predictor, but it's the same reason why Hollywood invests in sequels. Hey, the audience already knows and likes these characters. If we make a movie with them, our risk is less. If this founder has built a company and sold it before, we can look at that and say, well, at least we know that they've done it once, and that may be more than any of the other deals I look at this month. So I think there's a lot of just risk adjustment that is attached to the founder, and I think also founders, like, you want to signal from the founder that they understand what they're doing in a way that's unique and special. And so, like, when you're talking about like their view of the competitive landscape, some of the things that founders make mistakes about is they say, oh, my financials are conservative. It's like, well, why? Why aren't you being bold with your financials? Like, if you think that as an investor, like, I'm already playing in the high risk end of the pool here, right? So if you think that what I'm looking for is somebody who's just making sure that they don't fudge, they don't estimate too high on their, fudge is the wrong word, but they don't estimate too high on your projections, I don't care about that at all. I care about somebody who's bold, because I know whatever your financials are, right, you're going to miss 100%. You're not going to hit what you project. And so what I want is somebody who's still swinging for the fences, or the competition, right? It's like, well, I'm going to get crushed by the competition. What you want to do is not say, one of the worst things to do is say, we have no competition. Nobody's like, we're brand new, right? And so what that signals to investors is there's no validation that there's a market for your space. Probably the best answer is something along the lines of, yeah, here's A, B, and C competitor. They are doing awesome, but they don't have this that we have. We're going to kill them because we're doing this, even though so I have all this validation that there's a market for what I'm selling, but also I have an ace in the hole for how I'm going to beat them. That's a more compelling story. Joanna, am I answering your question okay? Do you have any other follow-ups there?
Yeah, no, that's super helpful. I am taking away all of the above, but I understand that there is sort of the rigor of the more functional things, but it's also the emotion that comes across as they're sort of delivering on that story. So thank you, it's helpful. Appreciate it.
Yeah, and I think qualities of founders is one of the things that you'll hear a lot of variety from, and a lot of ways that investors try to develop kind of shortcuts to understand. Like, I was just listening to a podcast the other day, and they're like, I want, I like founders with a chip on their shoulder. What does that even mean? But there's a sense of like, another one was I want a founder who has been, who acts like they've been wronged in a previous life, right? It's like because they're out to prove something. They're driven, and this is sort of a shorthand that investors are using to try to articulate what they mean by that. Because being a founder is hard. Like, you need somebody who's going to be able to overcome obstacles that probably, as an investor, you are leaving in your younger days. You don't want to overcome those obstacles yourself anymore, but you're happy to back somebody who will. And so parsing all of that can be tricky, and you never know, like, when your particular attributes are going to line up with some investor's shorthand. That kind of goes to the paradox of pattern matching. Some of those things actually keep investors from deals that probably should get more love, but such is life.
We're over time a bit, but if anyone has one more quick question for Chad, now's your time. 5, 4, 3, 2. All right.
Thanks, everybody.
Yeah,
great to be with you.
Thanks so much. This was awesome. I'm sure we'll have requests to share the deck. Are you willing to share the deck with the group here?
Yeah, for sure.
Awesome. If you don't mind sending that to Hannah, she'll send it out to the attendees and crew here. And Chad, I think you put your LinkedIn and/or email in the chat. I don't see it, maybe throw it in there, and we'll maybe.
Yeah, I think
Okay, perfect.
I'll drop it in.
Okay, please connect
Thank
with
you.
Chad. Yeah, he's fantastic. Thanks all for coming. We'll see you next week.
Good job, Chad. Thank you.
Thanks, Chad.
Take care, you guys.
Thanks, Chad.